Ever since Michael Lewis's book Flash Boys was featured on 60 Minutes, high-frequency trading has not left the conversation. Many Wall Street insiders have said that they've hated the unfairness of it, and they like the spotlight that the book has placed on this problem. Steve Cohen is the managing director of Wall Street Trading, knows firsthand about high-frequency trading. So, Steve, this isn't anything new, but do you think anything is going to change as a result of this attention?
This is not a new issue, and the one thing that I don't like particularly much is it took Michael Lewis's book to really bring this to the forefront. But I don't think anything is going to change in the short term. With the exchanges providing sponsored access, that comes at a very high premium. And until the exchanges actually lower their pricing and allow the general trader to afford that access, we're not going to see any change anytime soon.
Now, you make the analogy that this is similar to paying for front row tickets at a Broadway show. So if I want a good seat at the trading floor, I should be willing to pay up for that. But a lot of people say no, it should be fair and equal.
Yes, it should be fair and equal, but where it should be equal is on your access to price, where you want to be able to pay the best price for a security at the time you want to do it. And one thing that the prevalence of HFT has provided is a very narrow spread in a stock, which gives people access to the best price at the best time.
All right, so there's a lot of talk about maybe things that they could do to alleviate this situation, like maybe taxing the trade so that the high-frequency trader now is not going to make any money because they're paying too much in taxes for all these trades. Is that a viable solution if our regulatory agencies are not going to change it?
That could be one viable solution, but at the end of the day, if you were taking away all of that order flow, you could be putting in danger the price or the spread that you're paying. Now you don't have all of the orders inside of the spread, and people won't necessarily be able to get the best action or the best bang for their buck.
What would be a solution?
A good solution could be, well, that's an interesting question. There's been a lot of debate, specifically coming out of the chief of the Intercontinental Exchange, about the removal of payment for order flow. If you remove that, now all of a sudden you're getting a more level playing field. But one thing about technology is it happens to basically find its equal level. They will find something else. I know that's not a real answer, but the prevalence of IT and technology as it's morphed into these HFT practices, which actually at the end of the day have proven as much as there has been a benefit, there's also been a detraction. But if you remove barriers such as an order cancellation payment, an order tax, or removal of payment for order flow, they will find another way.
All right, well, that's the way traders work. They're always going to find the best price possible. That's Steve Cohen from Wall Street Trading. And I'm Deborah Borchardt with The Street.